Hey, hello investors, welcome to the channel. For today's video, I'm going to show you how to recover your losses and show you how to sell covered calls on stocks that are trading at lower than your average cost. And yes, I know, I've heard it before. You should never do covered calls below your average cost. But on this channel, we don't tell you what needs to be done. We actually show you how we're doing it. So if you're new to option trading or you're trying to get into options trading in order for you to supplement your regular 9 to 5, then you so happen to stumble onto the right video. Welcome to Investment Gains. Let's jump right into it. Welcome back, investors and future investors. My name is Tim, and on this channel, I show you how I use my portfolio in order to make consistent income. For today's video, I'm going to show you how to sell covered calls below your average cost and still able to make income. And once again, yes, it can be done. Now, before we get into these option strategies, I need you guys to do me a favor. Actually, two. One is to make sure you always do your own due diligence before investing. The second favor I'd ask of you is always make sure to have an exit strategy before you get into any options trading. That being said, let's go ahead and get down and dirty with options. So, for today's video, we're going to be using one of my favorite stocks for 2025, which is quantum computing, ticker QUBT. So let's go ahead right away and we're going to open up the option chain by going to trade QBT options to the bottom. Okay, so here we are on the option chain. And first of all, I'm going to go over to the options dashboard, or rather my spreadsheet. And I'm going to show you the average cost of these shares that I have in my portfolio. So let's go ahead and open that up. So we're going to focus solely on QBT right here. And as you can see, my average cost is $4,600. If you were to divide the $4,600 by 4 contracts, which is going to give you 400 shares, you should get an average cost of around $11.50. Let's go ahead and do it right now. Okay, there you go. So my average cost is 11.5. I should not be selling any covered calls below the 11.5 price range. Let's go ahead and go back to Robinhood. So now we're going to go ahead and we're going to sell our covered calls. So let's go to sell and call, and we're going to leave the strike date of February 7th. Now we're going to go ahead and choose our strike price. Now remember, I am not supposed to be selling any price below 11.5. So at the $12 strike price right here, you're going to see I have a very high chance of profitability of 89%, meaning there's almost a 90% chance that this trade is going to work in my favor. However, this is not going to work for me because the premium I'm going to be receiving is going to be only $10. As you know, on this channel, we engage in option strategies that give us income whenever we do those option strategies. We use this income to be consistent, and over time, that's how we grow our portfolio. So the $10 premium is not going to be good for me. So what I can do is go ahead and sell a covered call at the $11 strike price. Now, this is going to be below my average cost of 11.5. However, my chance of profitability is now reduced, but I still have a very high chance of profitability. But most importantly, look at my premium. My premium is going to be way high. So this is actually going to be $25 multiplied by 4 contracts. At this price, I'm going to get an additional $100 coming into my portfolio that I get to keep no matter what. But I have been trading this stock for a long time, and I always tell you guys, always take to a certain amount of stocks in your portfolio and trade them over and over again. What that does is that allows you to know the trajectory of these stocks, how they play, how they go up, how they go down. So I know for sure if I do use the $11 strike price, I will get a sign because this stock moves super, super fast. So what you can do, and we're going to come back to the $11 strike price in a second. One strategy you can do is to extend your time. So I'm going to move from February 7th to February 14th. So with February 14th, I'm going to be choosing a strike price higher than my current average cost, which is 11.5. And now I'm getting a decent premium of 0.25. Again, that's very good. The only caveat about this is that, once again, this stocks move extremely, extremely fast. And by going out one additional week, I'm now giving the option buyer additional time in order for the trade to work in their favor. So you could continue doing this. You could continue going out until you find a premium that works for you. However, with this strategy, you're going to be giving the buyer more and more time. So let's go ahead and go back to February 7th. Now, I'm going to show you how to sell your covered calls below your average cost. So let's go ahead and go back to the dashboard right now. So with the dashboard right now, let's go ahead. We're going to jump into January. I'm going to point out a few factors. As you can see here in January on QBT, I made $30 here, $30 here, and $30 here, which adds up to $90. Now, I'm not going to go up the other weeks. Let's just use this because it's just an example for this video. So what we're going to do, we're going to take that $90. We're going to go back to February. In February, we made $100. This is just for the first week of February. So now it's going to be $100 plus your $190. What that's going to do is that is now going to lower your average cost. So let's go ahead and do the calculation once again. Okay, so what we're going to do now, we're going to adjust our formula and we're going to subtract the premium we receive, which is $190. So just bear with me. It's only going to be some minimal calculation. So let's go ahead, put some parentheses here. We're going to subtract our $190 premium. It's some more parentheses, and then voila, that should do it. So now my average cost has now reduced to $11. Let's go back over to Robinhood right now. So now doing the exact same strike date of February 7th, I'm now able to sell covered calls at $11. Now, this can be done with any stock, and I always advise you guys always have an option tracker. With the option tracker, you're able to see how you're doing, how your entire portfolio is doing week over week, month over month, quarter over quarter. So now that my average cost is down, I'm in a way better situation. This is a good strategy to always keep in mind of because the market goes up, the market goes down. So whenever the market goes down, once you're able to calculate your average cost, then you don't feel so much panic. You can actually now go ahead and sell your covered calls at a decent price and still make a decent premium. So that is how you're able to recover your losses and sell covered calls below your average cost. Now let's take it a bit further. I'm going to go ahead and show you guys how to reduce your average cost with using options. So we're going to go now to sell and put, and now my average cost is, let's keep in mind, my average cost is $11. What I'm going to do now is that I'm going to change the option strategy. I'm going to be selling a cash secured put. Let's use the same date. What the cash secured put does is that it puts money into your pocket while you're trying to get the stock at a cheaper price. And this also helps to lower your average cost. So we're going to do a sell put expiration date, February 7th, and we're going to go with a 9.5 strike price. We're going to go ahead and we're going to select that. So as you can see here, what we're saying is that at February 7th, we do not mind buying 100 shares of QBT with 9.5. If we are assigned, now we're going to pick up an additional 100 shares at 9.5, which is going to go ahead and lower our average cost even more. Once your average cost is lower even more, whenever you decide to sell covered calls, then your maximum strike price is going to be lowered. Now, here's the best part about this. Not only are you doing an option strategy in order for it to lower your average cost, you're also going to be paid some kind of money while you're trying to lower your average cost. Now, tell me if this is not a win-win situation. And if it's not, let me know in the comments below. So in addition to your $190 premium, you're now going to add an additional $40 because each option contract is multiplied by 100 shares. Again, lowering your average cost even further. So whenever you decide to sell covered calls, always remember, always take your premium into consideration. Also, if the market has a very high pullback, do not worry. Switch the option strategy. Consider doing a cash secured put, which is going to lower your cost basis once again. But the whole point of this video is that you can actually recover your losses by switching up your strategies, and you could also continue to sell covered calls below your cost basis. If you found any value in this video, go ahead, like the video, subscribe to the channel. But most importantly, if there's anyone out there struggling to grow their small portfolio, well, go ahead and share the video with them. We specialize on helping people grow a small accounts portfolio. And if you guys need any information about any of these strategies, check out the links in the description below. Until the next video, pushing your investments.